Welcome back. This is Market on Close. Just a few minutes left to go in today's busy trading session here on Wall Street. So it's time now for the big picture. And let's welcome in the team from Charles Schwab. Liz Ann Sonders is Chief Investment Strategist at Charles Schwab & Co. And also joining us is Collin Martin, Director of Fixed Income Strategist for Schwab Center for Financial Research. My gratitude to you both. Liz Ann, let's kick things off with you. Momentum has clearly seemed to favor the bulls as of late. Where do you see as being the factors driving that strength, and how long can it last?
So if you look at the launch off the April 9th intraday lows up until this point, it really has retail traders' fingerprints all over it. And notice I didn't say individual investors, but retail traders, that cohort that grew out of the pandemic, younger, shorter time horizon oriented traders. When you look at various baskets like retail favorites, non-profitable tech, those have been the big outperformers, meme stocks. And what's also interesting is also outperforming has been heavily shorted stocks. Now, that's not so much the domain of retail traders, but suggestive of them sort of bringing the institutions along with them and forcing that short covering. So I think that's the nature of this rally. Where we are now, though, maybe we're not at extreme froth, but maybe suggests a bit of complacency has kicked in, which could mean some vulnerability if there's any kind of negative catalyst.
Yeah, I'm glad you mentioned that, Liz Ann. Collin, let me pivot the question to you here about that complacency that Liz Ann just laid out. Do you see that complacency as being a key risk right now? And what do you look for potential signs that could flip sentiment a bit?
Well, we're seeing a lot of complacency in the credit markets right now. That's something that I focus on and our whole team focuses on in terms of other parts of the bond market. What's the risk reward balance? And what we're finding with the riskier parts of the market is there's just not much reward for the risk that you're taking on. And high yield bonds is a really fantastic example there. When you invest in high yield bonds or a high yield bond fund, you're rewarded with higher yields compared to treasuries. It's called a spread. And spreads are just very, very low right now. So the idea that you just mentioned about sentiment kind of pulling and pushing the markets right now, sentiment is really strong, and that's what pulled those spreads down. But under the surface, there are concerns. We're seeing, some weaker corporate fundamentals in the first quarter. Corporate profits declined at an aggregate level. We're seeing corporate balance sheets weaken a little bit, and we just don't think it makes much sense to take so much risk if you're not being rewarded. So if that does reverse, maybe there'll be a better opportunity down the road to add some risk to your bond portfolios, but that's just not the case right now.
So, Collin, let me stay with you for the next one. Since you mentioned bonds and yields, obviously we're looking for the passage of the reconciliation bill out of Capitol Hill. It's one thing for equities to respond the way many market participants think that they will, but I still keep coming back to the actions of the so-called bond vigilantes around the time of those April 7th, April 8th lows. What do you think happens to the long end of the yield curve if and when this bill actually does cross the finish line in the next week or so?
Well, it seems like the bond vigilantes are asleep right now because they're not doing too much to scare away Washington from going forward with this bill. We do think the fiscal outlook and the idea that deficits are expected to stay high and our debt's expected to continue to grow, that can keep long-term yields kind of elevated or where they are and maybe trade in a tight range. And we contrast that with our short-term bond outlook, where we think short-term yields will probably continue to fall based on expectations for rate cuts at some point later this year. But given the idea that we need to finance our government with more and more debt going forward, we need to attract potentially new and more buyers to finance our government and to issue more debt. And that doesn't necessarily mean long-term yields will surge. We're not worried that the 10-year Treasury yield is going to rise up to 6, 7, 8%, something like that. But we think it might keep them where they are right now rather than falling in the face of rate cuts.
Liz Ann, how are you approaching positioning here ahead of what could certainly be a volatile second half to 2025?
Yeah, so instead of trying to time the market broadly and pick tops and bottoms, which I think is a fool's errand, as you know, we've had very much a factor approach. And I think one of the ways to think about the backdrop of heightened complacency, and I say this with a lowercase h, trying to hedge any potential downside. You can do it at the factor level by going back to some of those factors that were real anchors to windward during the correction bear market part of the downturn from mid-February until early April. So factors like dividend yield and stability, low volatility, lower beta, they don't tend to be the winners on the upside, but it's where you find some defensive characteristics, and those stocks tend to do relatively well if we have a bit of a pullback, assuming there is some sort of negative catalyst. Absent that, I think momentum, higher beta, but an emphasis on some of the growth factors like forward-looking growth trends. Those will be the factors that tend to perform well in this kind of backdrop.
Liz Ann, I'll stay with you for this next one here. Biggest market catalysts you'll be looking for, and even just the next few weeks as we kick off trading for the month of July tomorrow.
Well, both up and down could be. This week's jobs report is incredibly important for all the aforementioned reasons. You've got the July 9th deadline in terms of the extension or the delay of the reciprocal tariffs that were announced on April 2nd. July 4th, assuming that continues to be the deadline that President Trump has imposed on Congress for getting the budget bill through. So there's a lot of them just over the course of the next week plus.
Yeah, there certainly is. My gratitude to both of you for getting us going here just a couple minutes before the closing bell. Liz Ann Sonders, Chief Investment Strategist at Charles Schwab Co. Inc. Collin Martin, Director and Fixed Income Strategist for Schwab Center for Financial Research.